A modern construction site looks like a single massive operation, but structurally it is a fragile, fragmented web of separate entities. Dozens of independent teams cycle in and out before the concrete even dries. Main contractors rely on this fragmentation. It gives them flexibility to scale up or down as phases shift. But for the South African Revenue Service and Department of Employment and Labor, this sprawling ecosystem of subcontractors presents a landscape ripe for payroll abuse. This document outlines the mandatory contributions to the Unemployment Insurance Fund. When an employer misclassifies a worker as an independent contractor to avoid these deductions, they skip out on a mandatory 2% UIF contribution, along with standard PAY tax. The penalties for dodging obligations are steep. This SARS guide details the consequences. If an employer fails to pay with intent to evade, they face a penalty of up to 200% of the shortfall, and the employer becomes personally liable for that missing tax, which raises a critical question for any main contractor facing an audit. How do you prove which workers on your site are legitimate independent businesses and which are tax liabilities waiting to explode? Failing to properly classify the workforce transforms a completed project into a massive, retroactive financial burden. Let's start with the clearest example: specialized trades. When a main contractor hires an electrical or plumbing company, they are dealing with a true independent contractor. Legally, the distinction comes down to what the SARS guidelines call the object of the contract. This text clarifies the difference. A contract of employment acquires a person's productive capacity, while an independent contractor agreement is strictly for the result of that capacity. True independent contractors commit to delivering a specific product or end result. They are hired to wire a floor or install piping, not to hand over their ongoing daily labor. The definitive proof of this independence is the absence of control. The client does not dictate how the plumber performs the work or their exact working hours. Because these specialists pass what is known as the dominant impression test, their income is legally excluded from remuneration. The main contractor pays their invoice, and no PAYE deductions are required. The lines blur when we look at labor-only tiers. These are the bricklaying or painting teams that supply manpower rather than distinct project outcomes. Under tax law, these entities are classified as labor brokers. By default, the main contractor is required to deduct PAYE from any payments made to them. There is only one exception. This guideline explains the IRP 30 exemption certificate. If a labor broker holds a valid IRP 30, it acts as a shield, allowing the main contractor to pay them directly without withholding employee tax. But obtaining that shield is difficult due to the 80% rule. SARS will deny an exemption if 80% or more of the broker's income comes from a single client, unless they employ at least 3 full-time workers. It is a measure designed specifically to catch sham independent companies. Without an IRP 30 certificate physically on file for that broker, the main contractor is effectively assuming the broker's entire tax debt. The risk peaks at the lowest tier of the site, with informal laborers and general civil subcontractors. A signed independent contractor agreement here is legally worthless if the worker's daily reality tells a different story on site. This is the deemed employee trap. As the 4th schedule explicitly warns, if services are performed mainly at the client's premises and the worker is subject to direct control regarding their methods or hours, that income is legally deemed to be remuneration. During an audit, inspectors pierce the veil of these informal arrangements. If the main contractor's foreman is telling the laborers when to take lunch and exactly how to dig a trench, SARS relinks those workers directly to the main contractor's payroll. Control and supervision are the definitive markers of an employee. The title at the top of the contract is irrelevant. When the physical construction ends, the administrative scrutiny begins. The Basic Conditions of Employment Act introduces the concept of joint and several liability. If a labor broker fails to pay their workers or their taxes, the client, the main contractor, is held equally accountable. Failing to withhold PAY and UIF carries criminal weight. Business owners defaulting on these obligations face severe fines or up to 12 months in prison. The only defense is a rigorous compliance shield. This means vetting every IRP 30 certificate, applying the dominant impression test, and maintaining flawless payroll records. Proper workforce classification ensures the profit margin built on site isn't erased in the boardroom. SARS traces the money retroactively. They do not look at what a company intended to do. They look at who was actually paid and how their daily labor was controlled. A finished building might stand tall for a century, but a construction company's tax compliance is remarkably fragile. In construction, the difference between an employee and a subcontractor can determine whether a company survives a SARS audit.